Valuations have never been the easiest question to answer in India. Uh, so when you like India, that time the valuations are expensive. When the valuations become cheap, that time you realize, you start worrying about the reasons why India has become cheap, and then you're not able to invest. So India is like always in this catch-22 situation.
This is Allocating to India, conversation for foreign investors thinking about the world's fastest growing large economy, with the allocators and fund managers actually putting capital to work. Views expressed are the speaker's own and informational only, not investment advice. Full disclaimer in the show notes.
Our guest today is Sunil Asnani, Managing Director at Eastbridge Capital, a US fund investing across emerging markets, predominantly India, with a contrarian long horizon approach. Sunil led Matthews India Fund before founding his own firm, and he came to investing by an unusual route. Before investing, he spent 5 years as an officer in the Indian Police Service. We get into what the ground level view of Indian institutions taught him about assessing companies and promoters, and where foreign capital often misreads India. Here is our conversation with Sunil. Sunil, welcome to the show. You have a very unique background. IIT followed by IPS and followed by Wharton and then into investing. So please take us through your journey, how you have come to investing, and what has been your journey like.
Well, to be honest with you, it was never a thought grew up with that I have to become an investor one day. And every time I could see only a few years, ahead of the curve, that what is that I want to do in the next 5 years. I did not know that this is what I'm going to pursue for long term. So, like most people in high school, when they're good in only one or two subjects, and they think, okay, like I was good in math, for example. So I thought, okay, maybe I am for engineering. And after I went for engineering, I realized maybe mechanical engineering is not what I want to do. I want to do computer science, but then to get computer science in IIT, probably you need to get a very high rank. So, I think my interests were aligned with something which was more quantitative in nature, but it was still, mechanical engineering was not bad, but it was not like truly aligned with my skills. But at that point of time, I thought maybe I should be doing more managerial kind of roles where I need a bit of interpersonal skills, a bit of quantitative skills, and that's when I thought about doing an MBA or doing civil services. These two thoughts were in my mind at the same time, and I was not sure what I want to do. And then finally, I thought, okay, why don't I just park this question? Let me do both. Okay. And then how do I do both? The one option was that I can do an MBA first, right after college. A lot of people apply for IIMs. And after that, I will take civil services. And the other option was I take civil services, become an officer, and then after that, I do an MBA. The problem with the first approach was that if you want to join government full time, very is very important. So your seniority is based on the day you join. So if you are delayed by 2 years because you're doing an MBA, then you will be junior, right, compared to somebody who has joined right away. So I thought, why don't I do a civil services first and then do an MBA? And other disadvantage of the first option is that you will have to do it from IIMs. The IIMs are actually a great brand today, but 20 years ago they were still catching up. And I thought, if I want, like IIT has more name outside than IIMs do. Now they are equal, but in those days IIT name was more prominent. They were not, the brand was not like IIM's brand. So I thought maybe I should go do it from a global school, and where the work experience will be valued. And if I become a civil servant, your leadership experience and your situations that you encounter, they can probably be valued more by a school which values experience. So that's why I thought, okay, let me try the second approach. So my option was that, okay, I'll take civil service exam and then after that I'll do an MBA. So that was my thinking. So I could not think much beyond that. What I will do MBA, when will I do MBA, what will I do after MBA, those things were still not clear to me. So I applied for civil services exams, and usually they don't test anything except your academic skills. So they will test that, and then there is an personality test and interview. And after that, so I took that exam 2 times. First attempt, I got into railway traffic service, and during our railway traffic service for 1 year, I did a management development program for 3 months. And that time, I did some courses of at the business school, and I realized that I really enjoy these kind of courses. So my idea that to do an MBA was reinforced because I thought I will really enjoy it. And then after I became a police officer in Kerala, uh, I whenever I got time, I will prepare for GMAT. And after 5 years, I was able to get into US business school. And then my initial idea was that I will go and I'll come back and join the service. So, but after I joined, I realized that things are not as I thought they would be. First of all, I had this idea that these schools have a loan forgiveness program, that if you go and join government, they will repay your loan. So you don't have to repay your loan; they will do it for you. But after I joined, I realized that this program has very limited funding, and it is given to like one in you know tens of thousands. So it was very unlikely that I will get it. So my initial idea was still that, okay, I will work for a few years, repay my loan, and go back to the service. But after I spent a few more years and I was doing well in the US, and my wife and kids, they gotten used to it. So eventually I ended up leaving the other service. So this is my journey, how I came to become an investor and how I chose investing. Uh, when I was in business school, I realized that I enjoy, studying about businesses, but I also enjoy financial analysis. So I ended up joining corporate finance practice of McKinsey. And there also, if you want to remain a consultant, there is pressure for you to specialize in an industry. And I did not want to do that. I enjoyed, straddling between different industries. So I thought if I become a generalist investor, maybe I'll be able to do financial analysis at the same time, not be tied to any one industry. Lucky for me that 2 years into the job at McKinsey, there was a role at Matthews Asia which was looking for India analyst, which is a generalist role and looking at India. And I thought, what better way, to stay in touch with India uh, than to do this job. So once I got this offer, I joined them immediately, and I was with them for almost 11 years. So I think it was a lot of fun there. So long story short, yeah. So that's my broad journey.
That's quite interesting. You've actually been able to look forward 5 years and then plan accordingly. So between consulting and investment management, why is investment management more fun for you compared to consulting? Is it only because of the fact that it was sectors that you could study better in investment management, or was it also the fact that there was a little more ownership of the decisions that you were taking because you had come from a forces background where you were responsible for your actions? Consulting is more like giving opinions and giving advice, but someone else executes on it. Was that also something that really fascinated you towards this?
Sure. First of all, let me not deride consulting. I mean, of course, consulting has their pros and cons. Uh, Let me just explain what. So in a consulting role, you are doing financial analysis, and of course, you are consulting to somebody, but that is not a problem. I think if your arguments are good, you can consult people and you can recommend and convince them, into your way of thinking. There is nothing wrong in it. I mean, that is also an art. Uh, but I felt in consulting, you're basically always on a deadline. Like, let me give you an example. There will be like 3 deadlines in a day. Okay, so you're always like running on a treadmill. But investing roles are different. You have to don't run on treadmill. You have to sit back, think, and reflect on what is going on. So it's a different mindset, right? So I will not say I was a bad runner, but I think I enjoy more, you know, thinking through what's going on and and trying to put pieces together. So I felt in terms of my skills, it was more, it was more aligned. Uh, I thought that way. Of course, both were doing financial analysis, and McKinsey. All the financial analysis skills I learned was at McKinsey, and I was actually within corporate finance. I was part of this group called Corporate Performance Center, where this gentleman called Tim Collar, who has actually written this book on valuation, he was in charge, and I got to learn from him, and he really taught me the fundamental analysis. I feel if I had joined a bank, investment bank, maybe I would have, had a different view of how to do company analysis versus joining, McKinsey. So, if, in that sense, I think it was the right thing uh, for the long term.
Yeah. Also, Sunil, you have a very interesting perspective. You've spent some years in India as an IPS, and then moved to the US. So, how, in your, and also being investing in India for almost what 18 odd years now. So, how should a foreign allocator put a framework around India? How should they think about India? Do they need to put India in some bucket, or how do they evaluate India versus other alternatives? What's your view on the same?
So, first of all, we bucket India as a country. Uh, but if you see, many states in India are like, as good as big countries. So India is like a subcontinent. You can say that uh, if you look at the number of stocks in India, I think last time I checked, it was like 5-6 thousand listings. Um it is the oldest stock exchange in India. 2 years before Tokyo Stock Exchange, it was launched. Okay, and so in that sense, it is quite broad. I think depth wise, it's still becoming deeper, but India is not should not be seen as a country in silo. I mean, you can create a diversified portfolio in India. There's too many sectors, industries, and if you think that from another emerging market, it will be hard for you to come to that conclusion. Some countries will be driven by sugar, some will be driven by oil. You know, it will be hard for you to have an economy which is like more sustainable and not that volatile, right? Forget the stock market, but the economy itself is a very sustainable and a self driven economy, right? So creating a portfolio, a diversified portfolio for the long run is much easier to do in a market like India than a few other emerging markets which people club India with. So in that sense, India, people should not think of India as some country they have to invest to diversify out of some other country. Okay, they should think India as a asset class in itself, right? I think they have found this about China, but I think for India they are still catching up. And I will say, compared to China, I mean, of course, they've been growing faster. Now they are slower, but historically they've grown faster. But they are driven a lot by the macro and the government, right? They are much more dependent on global economy than India is. So I would say, in that sense, India is more sustainable economy, uh, uh, and less dependent on macro factors. Even though oil is a factor, even though policy is a factor, all these are factors. But in the bigger scheme of things, if I compare it to China, India has less such issues, and you can find companies where the companies are masters of their own destiny versus somebody else is driving them, right? So when you can find such stocks, you'll be able to create a better portfolio. So what I'm trying to understand is that make you sure understand is that India is a different kind of economy. It should not be clubbed like any other country. Second thing is, if you talk about diversification, a lot of allocators still not able to get out of their mindset. Historically, India was not, at least I do not feel that it is providing you the diversification you need. Not because the economy is not decoupled; it is very decoupled. But the markets were not decoupled. You could not get safety in India when you needed it the most. For example, look at 2000. Okay, India corrected more than the US markets. There were no such internet stocks in India, despite that. Okay. Then you look at 2008. India corrected more than the US market again. There were no such leverage banks in India. Okay. Despite that, India suffered that. Why did this happen? Because India was excessively dependent on foreign inflows. At one point, I think foreign investors held more than 20-25% of the market. Domestic investors were low. I think so. It was not able to provide you diversification when you needed it the most. Okay. So that was a wrong argument to begin with, and people were obviously disappointed with India. And at the same time, because of lack of liquidity, it used to be expensive. So I think historically, India, uh, I think investors used to have too much expectations from India and unrealistic expectations, which is why it did not deliver, and it is why I think India. But now things have become actually quite different in the last few years. Domestic investors, because of this financialization of savings, have become actually bigger now. Recently, I look at the total ownership; they are bigger than the foreign investors. Secondly, the number of listings have gone up. The liquidity in those listings have gone up. The level of governance has improved. A lot of companies which used to be family owned were acquired by private equity companies, and then they were turned around and they were relisted into the market. So I think a lot of these things have happened. And I would say India as a diversified portfolio, destination has actually become better. And it's a diversification away from US market has also become better because the fundamentals are always decoupled, but the markets were not decoupled. And now the markets have also been decoupled. And I think foreign investors should allocate to India also because this AI boom has not touched India to that extent. And a lot of frothiness in valuations you see, it is because of a handful of stocks, all driven by AI across the world. And if there is one way to diversify, I think India is one of the two ways you can diversify. If you look at the correlation between Indian markets and the global markets, the last few years, the correlation has actually gone down a lot. And the other market is China. So both China and India, I would say, provide diversification, true diversification plays at this point of time from all the AI-led, risks that we will see.
So India versus China. What do you think are the different uh, features of these countries, and why someone should prefer India over China if they want to?
Well, obviously, I'm a little biased because I'm from India, right? There is always a home bias, and people who are from America, they underappreciate the risks in the US and over think the risk in other markets. So there is some element there also. If I were Chinese, maybe I will underappreciate the risk of China. But I think that bias aside, I think in China, sometimes $1 billion company could be totally fake, right? They could be because there is so much of insulation and lack of openness and too much opaqueness in the China, so you don't really know the true story. And some of these companies like Muddy Water and though they have actually done some thesis, and they found that $1 billion+ companies were like completely based on. I'm not saying all companies are like that, but I'm just giving an example that if in India there have been a handful of companies which did like this and they were able to become big. I think in India there is more openness, more eyes are looking at you, harder to hide things here. And if you become $1 billion company here, it is very unlikely that you are based completely on scam or sham, right? So I would say that's one advantage. I mean, again, it's relative. It's not like India is an pinnacle of governance. There are a lot of things we need to improve. But at least if you compare to China, China is like 4 times bigger economy than India. In terms of governance, they may be probably 1/4 of where India should be, right? So that is one aspect. And as a public market investors, even if the company is doing well, if you cannot share the fruits with the minority shareholders, then what's the point? So that is the one big question mark, I would say, on case of China. It's not like you will never invest in China. You just have to be a little bit more cognizant of this factor. You will have to be cognizant of this factor in India also, but 3 times more in China. Second thing is the impact of policy. Now, of course, in India also there are a lot of policy-driven stocks, and I'm not saying, and I've tried to stay away from those stocks. But in China, it's hard to find a company which is not driven by policy. Even companies like in tech, in AI, you don't know that how much they are driven by policy. Maybe they will pretend they are not, but they are all driven by the regulators, by the government. So I would say if you want to find a company where the management is in the driver's seat and not in the passenger seat, then you will find more such companies in India than you will find in China, in spite of China being much more advanced overall. Other factor is qualitative factor is China is still driven by investments. Uh, like you will see that the goals that they are given to each province uh, on GDP. How do they achieve them? They cannot force people to consume more. So what they do to get those growth, they will construct bridges to nowhere, roads to nowhere, which will generate employment, which they will create real estate. It will lead to employment and growth. But then they will lead to it will lead to lack of utilization. For example, a lot of buildings, they are not even occupied, and that is why they have been probably able to contain it. But that real estate um, issue that has been happening there, it has been going on for a long time. So I don't think that is resolved even now yet. So, but at least in India, things get resolved faster. If there is a real estate problem, it will be resolved faster in India than it will be resolved in China. It will probably continue to remain under the carpet for a long, long time. So I would say comparing India and China, of course, you will probably get cheaper stocks there more often than here. But in terms of comfort with the governance and the business model, I would say you'll find more companies which suit you here. And then if you can find good companies with good valuation, then I think your broad risks are covered, except the INR depreciation. That's something which will be there. I mean, I don't think it's going away anytime soon.
Uh, Sunil, Eastbridge is a contrarian investor. So how do you maintain a contrarian approach in the Indian market, which is driven so much by momentum and driven by so much of by the retail investors uh, uh, who are kind of move their flows up and down depending on the sentiment of the market. So how do you apply this approach of contrarian investing in the Indian market?
Well, when you say contrarian, let me just clarify. We are like think ourselves as independent investors, independent thinking investors. Sometimes the market may be right. So for example, some cheap stocks eventually they become expensive, right? So when they are going up, we may also think like that okay, this stock should go up, and it goes up. So we are not contrarian in that sense, in the sense, but yeah, we do realize that most contrarian bets are independent, but not all independent bets are contrarian. Okay, but that said, uh, have a first principles approach. Take each stock on its own merits and think about all the aspects. How is the business quality? How is the management quality? How is the business going to become in 5 years from now? And at that uh, business, at that size and that profitability, how will the market look at it? So market is obviously short-sighted, and if right now the market is looking at the current numbers and the current business model, and if you can talk to the management and understand how they are trying to invest and do some research on the management quality and how much you can trust them and what are the odds of them becoming successful, then you apply those approach and take a longer term view, because momentum will not last 5 years. If it lasts for 5 years, then probably it's fundamental, right? So probably momentum will last 1 or 2 years. And if you can find a good company which will do well in 3, 4, 5 years, then I think you have to be more patient, and your investors have to be a bit more patient. So in our setup, we have a lockup, and which kind of allows investors who are willing to be patient uh, to be able to invest. So I think both sides it helps. If your investors are not patient, then eventually they will pull money at the wrong time, and then you won't be able to do execute as your strategy. But if both interests are aligned, then you're able to do it.
Sure. How has the risk profile of the country changed over the years that you've been investing here? Has the broadening of the sectors that are now available from a listed universe perspective, has that increased the allure of the country for you?
Well, India was always, I think, it was a destination of a lot of stocks. But I would say the level of liquidity has gone up. Uh, Now at the listing, you will see $1 billion plus valuations. When I had started investing, there were a lot of smaller companies which were good companies growing 20% every year, but their market cap was only $200 million, right? And they were listed long time ago. Okay, just to give an example, there was one pharmaceutical company I know, based out of South. They had been listed for 25 years, and their market cap when I first met them was only $200 million. Okay, and then I asked them that how is it possible? You must have been listed at like a very early stage. He said, "Yeah, that's correct." I said, "But most people don't get listed at such a young age. Why don't you uh, wait or get some private equity investments?" He said, "In my time, there was no private equity. We needed capital. So we went to the bank, and then the cost of capital was high. Plus, you have to bribe the loan officer. So if you look at all the overall cost, the cost of debt was actually more than the cost of equity. So we actually prefer to get listed because we will access the equity markets, which is cheaper. And it was in those days, it was easier also to get listed. So they got listed to set up their first factory. Okay, who does that? Okay. So they did not take any loan. There was no private equity. So they just got access the capital market, therefore, because that was the only and the cheapest source of capital available. And because of this, a lot of listings you have in India. Okay, and some of them actually were eventually shut down because they were not liquid enough. But this company survived and they were growing very fast. So I think the number of high quality and liquid companies has increased a lot. Secondly, I think the governance standards have gone up. Now, of course, there were a lot of family run businesses, and not all families are poorly run. Many of them are like very forward looking. Even then, they were like that. But I think the professional management has increased. The next generation of those families want to build wealth through market cap creation rather than taking away money from the company. Right. So I think their value system has changed. Uh, and I think SEBI has become, scrutinizing more the companies. So I would say a combination of these. I mean, it's not India is still a lot of work in progress, but I think its attractiveness from a business quality and management quality perspective has improved. Valuations have never been the easiest question to answer in India. Uh, so when you like India, that time the valuations are expensive. When the valuations become cheap, that time you realize you start worrying about the reasons why India has become cheap, and then you're not able to invest. So India is like always in this catch-22 situation. But if you can find a few stocks, if you're a concentrated investor, it's easier to find a few stocks which meet all the requirements, and you're able to take a call on valuation also properly.
Sunil, I'm going to pull two strings together. One is your background with being an IPS officer. So you obviously have a perspective which no other investors can have. And also we have touched upon governance a couple of times. I think one, you said the governance has improved. And B, governance vis-a-vis China, I think we also talked about that. So in your view, how do you assess companies, promoters, governance, and the gap between the formal rules and the real world enforcement? How has that changed over a period of time, or has that changed over a period of time?
Well, I mean, first of all, you should understand that the average level of governance in India is definitely lower than what you see in America. So the best of the governance here uh, probably is little better than the average governance here. Okay, so So when you're comparing the governance standards of India, you should not come with a US mindset that this is what I need. Because you have to differentiate between in India, there are two kinds of companies. Some companies are forced to comply, with the environment, and others are doing these things because as a source of competitive advantage. Okay, so you have to differentiate between the two, which are forced to do these things versus ones which are doing it because they want to make more money. So you have to differentiate among them, and if you apply that lens, then you'll realize that okay, things are not as bad, right? Because if in India, you touch with government almost like 50 to 60 times a year, normal company. If you go to Singapore or some other countries, it probably number falls to like 5 to 10 times, right? So when touch point with government is so much, the rent seeking behavior will be higher, right? And it is very hard to escape these things. Uh, to give an example, I have never paid any bribe in India, no, not even 100 rupees. But I know of some of my relatives. When a police officer comes and comes with your passport, and he says कि खर्चे पाने के लिए कुछ दो, right? Then you are forced to give some money to this guy. Otherwise, because otherwise you feel that this passport inquiry will not be done the right way, right? So there is a lot of pressure, for people. They become a party to the corruption without really any of their own interest, right? They are like forced to do it. So you have to differentiate between people who are forced to become a party versus those who are doing it actively to promote their interest, right? So first thing is that. Uh, Second thing is that I think in police, because I got to lead an organization, I realized that how incentives and disincentives work. Uh, I did not realize the power until I actually. You'll be surprised that with right incentives, even public servants can deliver very high performance. Okay, just to give you an example. When I was an ASP of a subdivision, uh, they were like the warrants that court send you. Uh, unless you execute those warrants, the trials cannot take place because these warrants are of witnesses who have not shown up, and then there are summons to call them first place, and then accused. If they're not present in the court trial, the trial cannot take place. Now I realized that the warrant execution level was like 20-30%. And I asked my police officials, my subordinates, why you're so low. He said, sir, we don't have resources. We don't have fuel for our car, and so we don't have enough money to run our day-to-day expenditure. And those problems are right. They actually get very limited fuel, and that finishes up very quickly. So for the moment, I thought maybe what they're saying is right. But then you see a lot of corruption at the ground level. They will go to an accused house, and if the accused is there, and they will tell them that, okay, I'll tell my boss that you're not here, but you have to give me something in return, right? And this perpetuates, this is one of the reasons why trials take so long. Even criminal trials, they take so long to finish because there is no accountability. Police feels that we are accountable to the executive, not really the judiciary in the true sense, because they report the line of chain of command is this way. And the judiciary, unless they get these warrants executed, they cannot run the trials. So it's like nobody's responsibility, and the end, the front level, police officer, they can make money out of it. It becomes like a money making proposition for them. So I understood the problem, but then I said, okay, then if you don't have money, then how are you able to execute even 20%? You should not be able to do even 1%. So, and then I said, okay, from now onwards, we will have monthly, monitoring of all the metrics. Okay. So there were like 10 metrics for every police station, and they had to comply with 7 at least. Okay. And the frontline constables, they also had a metric that they have to execute at least minimum 50% of warrants or 60% of warrants. And if they fail to comply that, if they are below 60% in a given month, then I will initiate an inquiry against that constable for that month. Okay. And if they are more than 75% execution in a given month, then I will recommend a good service entry for them. Now, good service entry is just an entry in your service book. There is very little reward, maybe a few hundred rupees, but it will be done every month. So it is possible that for 6 months you are getting a good service entry, but 7th month you may get an inquiry against you. The reason I was so strict was because I thought that there could be some accounting gimmicks. People can move, they can show good results for a few months, like it happens in corporate, right? And then suddenly there will be kitchen sinking, in 1 month. So I understood this part of reporting and accounting even at the police level. So I said no. So it has to be done every month. And initially they did not believe me that I'm going to be that strict. So first month happened, only one police station was about 50%, not even 60. And everybody else was 20, 30. So there were 10 police stations under me. So I initiated inquiry against all the constables in the 9 police stations. And the one guy, I told him that, okay, this time you improved, I will give you a reward. But this is only this time. Next time you do 50%, it will be a inquiry against you. This is only first and the last time. And you will be surprised. I did not have to do anything after that. I just had to strictly enforce this. And very little cash rewards they had. But the least I could do was, if somebody has done a good job in the whole police meeting in front of all the officers, they will be like clapped and they will be recognized for their effort. And after my tenure was over, out of 10 police stations, of course, everybody did the minimum 60%, but 7 or 8 police stations were more than 80%. Okay. So after I left, I got promoted, I became an SP. The SP of that district, somebody else came after me, an ASP. And he was surprised that between the 3 subdivisions, 2 subdivisions are 20, 30%, and this subdivision was 60, 70, 80%. So he thought they are cooking up the numbers. So he actually brought all the records. And he found that they are not cooking up, and they were actually delivering it, right? So, and this thing kind of helped me realize that with good incentives, both ways, it can work even in a public sector organization like this. You don't need to change the laws. Okay. Like a lot of people think that our laws need to be changed. We have a lot of laws and we don't need any more laws. We just need to be able to enforce whatever laws we got. I mean, of course, some law needs to be changed. They are archaic, I understand. But most laws are fine, and if you're able to align the incentives of the officials, they will be able to deliver. And if that's the same way it works even in private sector also, right? So, for example, I'll give you an example. When I was in the US, I was buying a house, and I noticed, actually not I, my wife noticed that in public records, the square footage is different from what this broker is publishing. It was like some difference, and I noticed the difference was almost like 9.9%. Okay, and then I thought, then I said, okay, let me go and measure. And there was a lot of resistance from the broker to let me measure the actual square footage by myself. They said, let's wait for the valuation guy who will assess and measure. I said, no, I will do it myself. And I measured every corner, and it was actually as per closer to the records, exactly like the records, and almost 9.9% smaller. Then I thought, how can they do in the US? I mean, it is like a cheating, right? Then I read the fine print. The fine print says that whatever broker says is an estimate. It's not a real. Secondly, if it is within plus minus 10%, it is not considered misrepresentation. So fine enough, they were like 9.9, just below the 10% number beyond which it will be called misrepresentation. So they were not breaking any laws. And you can think morally what they were doing is wrong, but they have a house to feed, they have a family to feed, a house to run. And within the limits of the law, their incentives told them to inflate, the square footage, because they will be paid based on the price of the property, and the price of the property is based on square footage, dollar per square footage. So it's not like India, any country, okay, any organization, private, public, incentives will make you behave like animals, and so you have to remember that it's not, this guy is not bad guy. It's just that their incentives are like that. So whenever you meet a company, make sure that their incentives are aligned. You see in many family-oriented companies, they will sometimes hire a professional like a CFO or like a not a real CEO but CEO title. Their salaries will be very less. The promoters, their salary will be like 10 times more. Okay, which will be like even higher than what you will pay somebody in US for that kind of job. Okay, so why is that? Because that's where the incentives are aligned, right? So they feel that it's better to take out the money from the company than to grow the market cap. Of course, now things are changing now. But I'm telling you that you have to make sure the incentives align. And a lot of private equity companies, they are not able to really understand the business model in India when they acquire a company. But they are able to align the incentives. They're able to attract a good CEO, they attract the right talent, and then they're able to align them properly, and so that there is no leakage of the cash, and then you pay based on, then they give them equity. So I think that's how suddenly the valuations will jump a lot when private equity company comes for this reason, right? So you will realize that the valuations can be double of what they are because the outlook changes suddenly. Even 2 or 3% extra growth, at a compounding level will give a big jump on the valuation. Right? So yeah, so I think if to long story short, I think I basically understood how organizations work at the ground level, how incentives matter, and also certain industries like real estate. Uh, I got very biased against those industries because you deal with them a lot. And then these loan sharks also, because a lot of these cases will come to you and they will use all tactics to extract, recover their loan. So I think I got exposed to these two industries and organizationals in general with this. And also, other thing is there were a lot of cases I had to investigate myself. So there was a research angle to that also. So, so I think when you talk to people, understand their point of view, record, and then put everything together, you are able to research the way you research a case, the same way you research and investigate, a company, and you say what is the real truth, what is the reality behind this, not what the market is telling you, right? So, what is it? So you try to see that these things could be different, and eventually they will converge. But at this point, this is what markets believe, and this is what the reality is.
The question, Sunil, is India has underperformed over last 18 to 24 months, right? And there are multiple reasons for it. There is AI investment which is happening in North Asia, and India has underperformed. There's capital which has moved to those countries. Also, as you correctly pointed out, India trades at a premium valuation, and especially in the light of earnings slowdown, which happened in last couple of years, the valuation looked more premium. So, what is your view of Indian market over the? How do you see this playing out? And what's your view over medium to long term on the Indian market?
See, if you look at the last 10 years, okay, Indian market performance has been slightly higher than the earnings growth. Slightly higher, not like 1% or 1.5%. But in the US markets, the performance has been way higher than the earnings growth. So I would not say that India has done wrongly. I mean, India has performed in line with the earnings growth. It is the US market which has done extraordinarily well, right? So I think the problem is not with India. The problem is with other markets where a few companies are, driving the returns based on the overall earnings growth. That's not the market performance because too much of is baked in the future outlook. So I would say India will continue to deliver based on its earnings growth. Maybe maybe higher or lower depending on, but it will be in line with this. So if you can find companies which can grow profitably, I am pretty confident that the market returns, unless there are governance issues, the market returns in the long run will be in line with that. And in the US also, it will happen eventually. Okay, I have no doubts about it. Maybe sometimes what maybe I think 5 years is long term, but some cycles are longer term than that, and maybe it takes a little bit more time to catch up to reality. Uh, but eventually it will. And I believe that while AI is needed, and I think almost everybody I know is using AI, there is demand. But there is a lot of difference between the perceived demand versus the actual demand. And if you give an example, I think look at internet. When internet was growing very fast, a lot of fiber capacity was laid because they expected internet to grow 1,000% in 1 year. Okay. Now internet grew by 100%, which is a very fast rate, but it was way short of 1,000% expectations. Okay. So I think that's where the problem lies in AI also. And I think people will realize sooner or later that AI is useful, but the cost of AI are underappreciated, the cost of computing are underappreciated, and at the same time, cost of infrastructure is underappreciated. At the same time, the demand is overstated, because when there is a capacity constraint, people overorder. Let's suppose suppose the chips are limited. Okay. Yeah? Like for example, in Indian markets also, you know that the allocation for a particular stock. Okay. Now people know that there are a lot of people who are getting allocated in this, say 50 million, 100 million. If I know that if I will be allocated only a tenth of what I ask, I will ask 10 times what I really need. Right? If I need 5 million, I will ask for 50 million. So I think the demand that you see has also that component. A lot of companies are over ordering the chips, what they think they will really need. And eventually you will see the overnight, I don't know when that time will happen. You might feel that capacity constraint will suddenly become a glut. And when will that point happen? I have no way to figure it out, but that point will come. I believe that.
So, in your investing in India, how do you factor in currency across the portfolio?
So, first of all, if you look at the hedging cost, okay, if you're investing for the long term, say 5 years, 10 years, then the hedging cost, first of all, it will not be easy for you to hedge for 5 years or 10 years. But if you have to, say, hedge for 1 or 2 years, then you roll over, and that's how you hedge over 5 years. The hedging cost will be actually more than the rupee depreciation. Okay. So, point is to not try to beat it. I think what you should just understand that rupee will depreciate against the dollar, because the inflation in India is higher than the inflation in the world. That's a fact. Okay. Of course, there is some imported inflation, but in India, if you look at RBI, their expectation of inflation is like around 4-5%. Here, it's 2%. Obviously, even the RBI doesn't want inflation to be in 1 or 2% in India. They want a higher inflation. So when you have higher inflation than the rest of the world, then obviously the currency will depreciate. Right? Think of this like suppose a burger costs 50 rupees in India and $1 in America. Let's put it this way. Okay. And suppose the rupee depreciates. I suppose the prices like go up. And in India, after 5 years, this one burger costs 100 rupees now. And it still costs $1 in the US. Just I'm putting very things simply. Of course, there are a lot of other nuances. Point is, the currency has to adjust to this new reality. The same burger is costing 100 rupees versus $1 in the US. So it has to adjust to, if the currency rate is 50, it will become 100. Now, the currencies don't depreciate that fast, but I'm just giving you an example that when things become more expensive in India than in the US, the currency has to adjust for that. Currency is that adjuster, right? And India is more or less an open economy. RBI can put temporary controls on the volatility of the rupee, but eventually it will settle to where it truly belongs. Okay. So unless you fix the inflation, which you don't want to, because RBI doesn't want inflation to be 1 or 2%. Right? RBI wants, because inflation is not a natural phenomenon, it's a man-made phenomenon. It's the monetary policy's decision what inflation I want. Okay. So they feel that unless there is if the inflation is 4-5%, probably the growth will be faster. If the inflation is 1%, the growth will be slower. Right. So that is also a fact. And if they want the India to grow faster, they will have to have a higher bar for inflation. So I think that's why I believe that rupee will continue to depreciate. Look at any long periods, rolling 5 years, you will see 3-4% depreciation, and you should take that into account when you invest.
Yeah.
Sunil, you've been investing for almost 18 years, and as investors, things change, our perspective change. There is a lot of learning which happened in the market. Uh, so, where have you changed your perspective over the years of your investing career? Where have you moved, or where have you changed view on the Indian market, or a nuance or a perspective on the Indian market?
Um, well, what can I say is that when you see more cycles, right, you learn what you thought was, gonna stay but did not stay. Right, there are certain business models which are more evergreen than other models. For example, when I first met a gold loan company, I was mesmerized by their ROE and their business model. I felt that collateral is so liquid, and you know, I don't know what can go wrong. Is such a good ROE business? And for a while they did well, but then I looked at other markets where the not India, other markets like Japan, for example. Because I used to work for Matthews, I got perspective from many Asian countries other than India. So I realized that these gold loan companies, they also became very big in the beginning, but then once they became too big, the regulators started clamping their wings, right? So those factors I had not considered, right? Um, so I think, and eventually, and I realized that gold prices have a big contribution to gold loans, and the way the governance levels were still catching up. Like governance level were maybe, of course, better than the zamindars, who will do pawn on the pawn shop guys, but they still were trying to make a quick buck. And when you do the loan to value calculation of a jewelry, they were also including making charges. There are a lot of nuances which I did not appreciate in the beginning. Okay, so they will give like 80% LTV, for example, and they will think, oh, 80% is good enough. I now I realize 80% is a lot for a gold loan compared to something whose prices, don't change a lot, right? For example, suppose a house loan, if you give 80% LTV, it makes sense. But when you're doing for a gold loan, you can't do 80% because prices are so volatile, and these guys are including making charges also, sometimes. So I think there are a lot of nuances which you appreciate as you go through cycles and swim through these businesses, and it is different by every industry, right? One thing I will say is that in certain cases, management quality matters more. For example, where the business quality is not super, it is okay. There, the management quality matters the most. Okay, and sometimes management quality becomes the business model. For example, in banks, management is everything. They will change, they will share the course. In few years, the company will have a strong moat of low cost deposits, and they will be more sustainable, constant source of capital, less dependent on public markets or less dependent on debt markets for their growth. Uh, I mean, of course, you're always in debt markets, but you'll be get better rating if your deposit franchise is better. Your cost of governance has so much impact on your cost of capital you don't realize. Okay. Uh, for example, I give an example. One company, like a very good conglomerate and very well known for their governance, gold standard of governance, they entered some power projects. Okay. Now, power projects are SPVs, and if you don't pay the loan or back on time, there is no recourse to the parent. Okay, but this particular power project, it was ultra mega power project, because of the coal prices went up a lot, the project became unviable. So what this group did was, first of all, they bought coal assets in the parent's name and has signed long-term agreement with the SPV so that they get supply of coal, and any debt which these guys are not able to pay, the parent took the responsibility to repay those loans. They did not need to do it. There was absolutely no need to do it. But I think the debt integrity uh, is the litmus test of governance. Okay, even though it was not really their job, but they took on the responsibility, and that is why they get the lowest rates of interest. Just that group is behind you, the parent is behind you, you'll get the lowest cost of capital. So governance is not just protecting your minority investors. Of course, that is also there. It is a true source of competitive advantage. I think that thing learn to appreciate when you go through. At that point, I was thinking, why are they so silly? Why are they trying to do this? Because it was against the public market investors because you are doing this, expensive proposition. But over time, I realized that in the long run, it is good for public market investors also because the cost of capital will be into the economics, and eventually it will help the public market investors. So I think these are a few things. But yeah, again, it's just more comfort and better appreciation of the problems, better appreciation of the governance. One last thing I wanted to say about India markets attractive. Overall, I think the standards have improved. But after they introduced this capital gains tax, I think even though India has so many good companies, the relative attractiveness of India has gone down. The reason is because many of our investors, they don't pay taxes. They are endowments, and they don't pay any taxes anyway. So whatever taxes are deducted when you sell a stock in India, they don't get any credit for it. So a lot of long-term investors have found earlier what happened was that it was there for short-term tax, but long-term gains tax was zero. But so if you invested for the long term, you could still manage to do that. But what is happening is that even long-term rate is also there now. There's some surcharge also, and it has actually been increased. So I think if you compare it to other markets, you should not even have that tax. Uh, and for domestic investors in India, they don't have any such tax. It is only for foreign investors that it is withheld when you take the money back. Right? In Indian market, you don't have to do that because you can all, and even if you do, you can always take credit. But in the US and other markets, they can't. And even if they are able to take credit, if they are on a zero tax thing, what will they take credit against, right? So I think that is one area I think India can rethink and reflect and change those rules.
Yeah.
So, what advice will you give your younger self when you were just starting out?
Well, I mean, how young? Uh, Depends on that.
When you were just starting out in this domain, like when you joined Matthews first year?
I see. I think I would like to keep that younger self. I'll tell you why. Because as a younger self, you have like a beginner's mindset. And I think every time you look at a stock, you need to think it from a fresh perspective because it's of course, you want to learn from whatever you have learned about a business, but sometimes it creates biases about certain business models. And what happens is sometimes the business models are changing and governance are changing. So if you are stuck in your old patterns, then you'll miss the inflection point. So I think I would like to learn from experience, but at the same time, retain my younger self, beginner's mindset, if it is possible. I'll give an example. For example, real estate. Okay, real estate, I had a very negative view, and in the beginning, my view was reinforced. The way the governance standard was. But I think some real estate companies are changing. The laws have changed, and I find some good quality real estate companies now. Some of them are actually expensive now, but I'm saying if you had caught them on time, you probably would have, made decent returns. So when business models are changing for better or worse, for you be able to get out of that pattern, you need a fresh mindset. And so I would like to rather not give any advice. Rather, the advice would be to keep your younger self with you, the same enthusiasm and researching, and same beginner's mindset while still learning from your experience.
Yeah, makes sense, Sunil. I think that's a very good recommendation. Uh, Last question from our side. What conversation are foreign allocators having about India that they should be having about India? They need to talk about things which they aren't talking about.
So I think I'm not sure if a lot of people are having conversations about India. You really, it's like finding a nail in the haystack. I think the UK markets and I think Southeast Asian markets, they are more sold on India than in the US. Of course, the number of funds have gone up since I started looking at it, but it hasn't grown exponentially, I would say, in India. And I think Asia has become an asset class. Uh, to some extent, China has also become an asset class, but not India. I think there is some way to go. And I think the same questions that you asked, the governance, and a lot of people still think in the US that a strong government is what India needs. Okay, India needs, because most reforms in India were made when India was like a coalition government, right? So they don't appreciate the democratic uh, power of India. They rather still believe that there should be a strong government so that it can implement reform. Reforms are like accepted across all parties now, and I think coalition or not, it doesn't matter, right? So I think that fascination with strong government is mistaken, first of all. And second thing is, they in some way they are asking about the same questions about this rupee depreciation and the taxes. I think those are the conversations they are having. Of course, they buy the diversification argument. They used to buy that argument even when it was not even true. Okay, uh, now it is true. The diversification can be one of the reasons to invest in India. And at the same time, I think they do appreciate that there are a lot of companies, but sometimes they're worried about liquidity. They are worried about Indian rules and regulations, which will stop them from taking their money. So those are their concerns they have. And uh, Usually it's hard to convince them to buy India. They are already convinced, and we can tell them why we are a good way to access this resource, access this investment destination. But usually, I find it hard to convince them out of, because there is a lot of home bias. Hard to change it. And a lot of people tell me that if I am getting 15% dollar returns by investing in index, why should I invest in a fund where my money will be locked and I will get less than 15% dollar returns annually, right? So obviously, but after US, I would say the market which has done well over the long term is India. So that is also true. No other market comes close.
Yeah, so India is done really well in long term. I think short term the performance has been quite challenging, but appreciate your thoughts, Sunil. I think this has been a very good conversation. We have learned a lot. Your examples were quite insightful and were very unique for us to understand and appreciate the Indian investing environment. Thank you so much for your time.
Thank you, Saurabh. Thank you, Nitin. Hope you're having fun to investing in India.
Thank you.
Thank you. Thanks.
Thank you. Bye.
Bye.